Hello, incoming management. On the behalf of Digby's exiting management, we would like to say that we're very proud to be handing over a financially sound company. Digby's strategy of paced, consistent growth worked as we ended up on top. We were first in final score relative, first in market share of 23%, first in final round sales of 162.7 million, first in overall contribution margin of 59.7%, first in ROS of 30.1%, first in ROA of 35.7%, first in share price of $111.22, first in market cap of 362 million, and first in EPS of $15.04 per share. In regards to our strategy, we chose to be a broad differentiator with a product lifecycle focus. We focused on introducing attractive, high-end products, building accessibility, awareness, and pricing above average. As products grew older, we would naturally shift them down from high-tech into low-tech. We developed large R&D capabilities in order to produce new products, reposition old ones, and shift our high-tech products down to low-tech. These R&D proficiencies allowed us to adjust to new market conditions and prospects. After analyzing and assessing our position at the end of round 4, we came to the conclusion that our strategy of being a product differentiator with a product lifecycle focus was a viable long-term strategy. In respect to our competition, we saw our position as a competitive advantage. All other competitors occupied one segment more significantly over the other. Ferris, purple, and Andrews, red, were pursuing strategies of niche differentiators in high-tech, while Baldwin, yellow, Erie, orange, and Chester, green, all had greater presences in the low-tech segment. For this reason, we believe that straddling both segments equally would allow us to capture a wider market share and use our R&D proficiencies to our advantage. We built automation capacity and heavily invested in TQM in order to threaten our competitors on a basis of margin in both segments.
Our strategy within the Research and Development Department was to be a product differentiator with life cycle focus. To implement this strategy, we start with our products in the high-end market segment and transition the products to the low-end market segment as new products are released. During our 8 years in management, we released 3 products, Daze, Dare, and Dave. Daze was released in the first round and targeted the high-end market segment. In the third round, we then released Dare, which captured the high-end market segment. During the third round, we transitioned Daze to low-tech. In round 6, Dave was ready to launch. Dave was positioned in the high-end market and we transitioned Dare to low-tech. In order to achieve the highest market share and customer survey score, we had to monitor and change age, MTBF, and price to fit the ideals of each segment.
As you can see, as the number of products increased throughout the rounds, more and more money was allocated to both promo and sales budgets. As we became more profitable, Digby's strategy was to spend more in these areas to increase our total spending and therefore total benefit. In addition, within our strategy to be a differentiator with product lifecycle focus, we priced our products high in the range of $40 to $45 for high-tech and $30 to $35 in low-tech. With the goal in mind to achieve 100% accessibility and awareness, we were cautious not to reach the point of diminishing returns by not spending past $2 million. By the end, we had a high total spending budget, which we believe contributed to our overall success. Looking at our average awareness and accessibility percentages, it is evident that they increased over time. This may be attributed to our increased total spending as the years proceeded. Our high percentages in both areas contribute to our high final customer service scores. as it allowed us to reach more consumers and capture more market share. Additionally, we believe our increased spending in training and recruiting heightened our overall productivity, contributing to our overall performance.
In Team Digby's production department, we began the simulation by focusing on buying additional production capacity. This additional capacity allowed us to increase our total available output in order to capitalize on high demand in the first few rounds. This would lead Digby to experience higher market share in both the high and low tech segments. Upon the release of DARE, we initially bought limited capacity before expanding in preparation for the transition to low tech. We also continued to increase Dave's capacity as it was now primarily competing in low tech where more capacity is needed. In the later rounds, we bought and maintained limited capacity for Dave as it was going to compete primarily in high tech with no plan to transition into low tech. In order to prevent stockouts and to allow Digby to take advantage of unexpected opportunities in the market, we would always overproduce based on our forecasts. We found that the carrying costs of a few extra units were outweighed by the potential benefits of making that many more sales. As the simulation progressed, Digby found that many of its competitors had considerably higher contribution margins. In response to this, Digby began to invest heavily in automation in round 6 and continued to do so until our margins became competitive once again. Finally, at the end of the simulation, Team Digby had the highest return on assets in the industry, which indicates that we were being most efficient in the use of our capital assets used to produce sensors.
In the first year, about 81% of our expenditures were financed through long-term and current debt. But as our cash balance began to increase and we became more desirable to investors, we decided to retire most of our debt and begin to finance our operations through equity. By the end of the simulation, we had issued over $40 million in common stock. The graph represents how our equity and debt levels changed over the 8 years. By the end of the simulation, our capital structure comprised of 95% equity and 5% long-term debt. For this reason, we are almost entirely unleveraged, which allowed us to minimize our interest expense, further decreasing our liabilities. In the last few years, we decided to pay dividends to shareholders as a way of attracting more investors and keeping current investors. We also repurchased 5% of common stock in order to decrease the amount of dilution and increase earnings per share. In doing this, we succeeded in securing the highest market cap and the highest share price. Throughout the simulation, we decided to lengthen our accounts receivable period to 60 days in order to incentivize customers to purchase from us. We were capable of doing this as we had enough cash on hand to allow for a delay in our accounts receivable. By the end of the simulation, we accumulated just over $130 million in profit. Due to our low debt, we were able to achieve an extremely low debt ratio of 0.06. This means we are handing over a very liquid company to you, the new management team.
Our investments in TQM were essential for reducing administrative labor and material costs, reducing R&D project times, and increasing demand. Initially, our strategy was to invest heavily in TQM as we increased investments every round from rounds 2 to 4. Although our large investments in TQM seemed to have minimized our net income in the beginning, we were more focused on our long-term goal of maximizing our returns. We spread money by a rather equal distribution of investment amongst all possible TQM initiatives. In the later rounds, Digby did not invest in TQM as our goal was to minimize expenses and increase returns to shareholders.
Team Digby was able to accurately address cash flow to ensure our needs would be met in every round. This meant no emergency loans were taken and therefore no extra expenses were incurred. Looking back, Digby planned for a level of worst case scenario that was too conservative. During later rounds, we had problems dumping cash and therefore lacked productivity of capital and did not return as much value to shareholders.
Digby heavily invested in TQM capacity and automation in order to achieve endgame superiority in respect to contribution margin. TQM was used in rounds 1 through 5 to minimize material and labor costs long term. Capacity was built as needed in order to produce at around 125% capacity in order to maximize ROA and to lead to efficiency of assets. Automation was built to 10 on low-tech products and 6.5 on high-tech products. This allowed our more stationary low-tech products to almost eliminate labor costs while lowering labor costs on high-tech products, but still giving us the ability to move the product. Overall, Digby was able to end the game with the highest contribution margin of 59.6%.
Digby was able to achieve an ROA of 35.7%, the highest in our industry. A combination of automation, product placement, price, proper capacity, and TQM allowed our ending ROA to be industry-leading, reflecting our overall efficiency of our business model.
Digby ended number 1 in market share as a result of our broad strategy. We were able to tap into both markets and access a wider range of shareholders.
Because Digby only started investing in automation in round 5, our contribution margins bounced back and forth above and below the industry average from rounds 1 to 5. Looking back, Digby had the capital assets and ability to leverage early growth in automation and therefore should have done so. Starting to ramp up automation 1 or 2 rounds earlier would have allowed for greater returns to be realized.
In rounds 1 through 5, Digby spent a large amount of money in TQM and had high variable costs. as these two elements both minimize our net income. If we were able to better spread this investing amongst many years, Digby would have been able to see linear net income growth rather than exponential at the end. Although this short-term thinking may have ruined Digby's competitive advantage and not have allowed us to end up on top. In addition, looking back, although Digby experienced a great amount of growth within the 8 years of the simulation, this growth could have been much larger than it was. In retrospect, Digby could have been leveraged above a ratio of 2 for the first half of the simulation. This would have allowed us to expand our asset base even faster and therefore would have lengthened the period that we were able to focus on profitability.
In regards to Digby's incoming management team, our recommendations are as follows. Digby currently holds a commanding position in the industry, and in order to continue to grow our market share, additional debt should be taken out in order to finance new investments into production, R&D, HR, and TQM. Digby can force out smaller competitors within our strong current financial position and become an even larger player in the industry. Next, while Digby is expanding and incurring a lot of expenses through aggressive spending, make sure to space out spending between rounds, instead of a lot of spending one round and followed by minimal spending in other rounds. This balance of spending will create more stable results and ensure Digby's cash position is less volatile. Digby should continue to follow its strategy of being a differentiator with a product lifecycle focus by introducing a new product into high tech as soon as possible. This will allow all of Digby's current products to transition down into low tech and eventually retire our first product to days. When transitioning products from high tech to low tech, the differences in the segments cause a need to lower MTBF and price accordingly. Additionally, investments should be made into automation and more capacity for products in low tech, in order to have competitive margins and keep up with the higher demand in this sector. Digby's current management team believes that we are handing off a financially sound company. If the above recommendations are followed, then we believe Digby will maintain its position as a market leader in the industry.